radio for a really great future. We're talking real money.
It's Talking Real Money time. Hi, everybody. I'm Don McDonald, and we're here to talk finance. Not really high finance, not even complicated finance. We're just here to talk about your money so you can make more of it. I'm Don McDonald. I'm in Florida. Tom Cock is over there. He's out in the wilds of Washington somewhere. And we're so thrilled you're there listening to us on the radio and then maybe later listening to us on our podcast, which this becomes. Speaking of radio, I want to issue wait, let's do it right. Hypocrisy alert. There, I did that right.
You did do that right.
Thank you.
Scary.
A little scary, but not as scary as this.
Wow, that is awful.
I just discovered new things I can do.
Sound like you had something for breakfast you shouldn't have had there or something. Yeah.
Now, we know we're on the radio. We're on the radio, right, Tom?
I think so. I'm hearing it, but
so
that doesn't
we're
mean
on the radio.
So.
We're on the radio in Seattle on Northwest News Radio. And we know there are a lot of financial shows on the radio. However, of those, there are maybe in most markets up to maybe two. Sometimes, okay, maybe three. You got Jill. She's not in some places.
I'm trying to think of who the other ones are.
Well, there's another fiduciary advisor who has a radio show. They're a fiduciary.
In Seattle?
Yeah.
Okay.
Yeah, you know them. They're out of California, but they have an office in Seattle.
Okay. Yeah, I know who you're talking about. Yeah, okay. Yeah, they are.
So there are a couple. There are a couple fiduciaries.
Good point.
But the vast majority of those shows that you hear talking about money on the radio are really horrid. The advice they give is beyond self-serving, and they're not fiduciaries, but not 100% fiduciaries by any stretch of the imagination. And one of them who claims to just be an educator, he's not even a person who can help you with investment products, not real investment products.
No,
turns out he's not a stockbroker.
Nope.
He's not an investment advisor.
Nope.
No.
And
what is he?
He's not what he calls himself, which would be a teacher of the highest rank in a college or university. You can read between the lines to figure out what word I'm talking about there.
Oh, you looked up the definition of the word.
I did, because I was curious to see what old Webster would say. This is a person that I think the word, it starts with an S. Salesperson?
Yeah. Thank you. You were going to say salesperson. I was worried you were going to say something else, but you said salesperson. That's actually really good. And how do we know that this person is just an insurance salesman?
Because that's all that he offers, right? And he's got
that's all that he's licensed to sell.
Correct. Nothing else. As I said, he's not a financial advisor. He's not even a broker dealer. Nothing.
Nope.
Zero.
He's not licensed in any of those investment areas that require registration. He is merely licensed as an insurance salesman, which limits what he can sell to you in terms of money-making investments. And he's limited to really basically two things: life insurance and
annuities. Yeah, it's fascinating too. The product that he tells people is the perfect solution for you. I'm sure it's always the perfect solution for whoever.
It has to be for almost everybody who talks to him, because he can offer really nothing else.
Yeah, it's a really great. And this is a person that was looking like they're near retirement. They wanted income. They wanted a guarantee because they didn't like to be nervous about their money. And they were told, yes, you by this representative, this salesperson, you put your money in and you're going to make 9% a year. 9% a year. Guaranteed.
Let me just tell you that is literally impossible. There is no way that could happen. And they have the problem is you have to actually be able to read and understand and comprehend the sneaky little nuances of their disclosure documents, because they show you some numbers, but the real number is a whole lot. For example, $1 million in this annuity actually grows by 3 or 4%.
I know. We've discussed this, but it comes up like it's like that bad penny. Can we talk about pennies? That keeps getting turned up over and over and over again.
We will talk about the pennies too. There's a change in the wind there. 855-935-TALK is our telephone number. That's 855-935-8255. Give us a call.
Tom and Don are talking real money.
Hi, Don McDonald here. So, what's your plan for retirement? No, really. What's the actual plan? Because hoping the market goes up, stockpiling random investments, and praying your gut instincts are smarter than Wall Street is not a plan. It's a guess. And when the market gets bumpy, and it always does, guessing leads to second guessing. And second guessing leads to panicking. That's why you need more than a portfolio. You need a purpose, a strategy, a real financial plan built just for you by a 100% fiduciary advisor who's legally obligated to act in your best interest. Imagine that. Start your plan today with a free, no-pressure meeting at TalkingRealMoney.com or call 800-386-3004. That's TalkingRealMoney.com, because your future deserves more than crossed fingers and wishful thinking. By the way, no sales pitch, no obligation, just smart help for real people who want to stop guessing and start planning. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more details.
Your guides to a really great financial future. Tom and Don are talking real money.
855-935-TALK is our phone number. That's 855-935-8255. I'm Don McDonald with Tom Cock, and let's do some numbers. This is the product that the money educating guy on the radio is going to try to get you to buy. We know this because we've talked to his customers or potential customers. We've looked at it. I've got it right here in front of me. I've got the disclosure document from Nationwide. Now let's look at the real numbers.
You careful there. It ain't real anything. It's on paper.
When you're getting numbers from an insurance company, you have to remember some really weird things. For example, indexed annuities are based on the return of an index, a portion of the return of an index. Well, in this annuity, Nationwide is using an index that isn't even a year old. So
what they did is they go back 10 years and data mine everything that worked and say, look how much this made the last 10 years. Just invest it this way. Although the next 10 years could be completely different, obviously.
Here's a chart of the most recent 12 years, non-guaranteed hypothetical illustration.
Come on.
All right. So wait, now here you go. You put $1 million into this annuity. And in 12 years, according to their hypothetical thingamabobber, you now have $1.4 million in contract value. It's the value of your contract. No. That's the contract value. That's technically would have been the real money had this index ever existed, which it didn't, and it may never do this again. So we don't know. However, let's say you wanted the guarantee, right? This is only if the market did really well.
Yeah.
Really well. Let's say you're just on the guarantee. Your contract value by year 12 has dropped after because you've taken some income for several years, starting at age you're taking a 5% income out.
Yeah.
Your value by year 12 dropped to $69,000.
It's kind of down. Let's talk about a couple other things.
I got to give you one other number.
I got one better than yours.
If you invested it for 12 years at 9% like they quoted, you'd have $2.9 million.
Sounds easy. I got a better number for you.
Yes.
$90,000.
No, it's 80. I checked. You're wrong. It's not 90. It's 80.
Pardon me.
I'm sorry. It's 80.
$80,000 is what the representative makes for one afternoon of work. Now, do you think that person's motivated to get you into this product?
$80,000? That's a lot of money.
I would be like, let's get you signed right now.
I mean, I could sell if I was lying to people, I could easily sell 4 of those a year. And I would make more money than I make right now.
I know. It's crazy. So a couple other things to think about here that were very disturbing to me. Number one, this money was placed in an IRA. I don't see any reason to own an annuity like this in an IRA ever, because you're paying, in a sense, for something you already have in an IRA, which is tax deferral. Doesn't make sense.
Well, I don't see any reason to own an annuity like this.
Number two,
period.
Which is the part that you alluded to, but I want to make completely clear that the only guarantee is between you and the insurance company. Right. That's it. There is no, this is not the U.S. government. This is no other entity that can guarantee payment. Period. So, and then they have a rider in here. There's a bunch of other stuff, that I find disturbing, but I find it mostly disturbing that people listen to this and they think, yeah, I found financial nirvana. This is perfect. I got it all set. I got the income. I got the guarantee, et cetera, et cetera. And that's the part that really upsets me and worries me, frankly.
There is no magic. And by the way, where do they come up with that almost 9% return that they're quoting to people? It's really tricky. The number that gets to that 2.5+ million number is called the High Point Income Benefit Base. That's not real money.
That's simple, right?
That's the base on which they generate the 5.33% income. So they're basically saying, we're going to give you a 5.33% income on $2.5 million for the rest of your life. Now, that's not real money.
Exactly.
Sorry. This stuff just
school, as they say, is out, I guess, right? Then under
this school should, in my opinion, this school should be permanently closed. And this is one of the biggest problems with the regulatory environment in this country, that if you pay enough to, and boy, are we in it now, if you pay enough grift, you're going to get rules you love. Yeah. The indexed annuity industry was originally going to be regulated like a security because they were promising returns like securities. But guys like the money guy, the money teacher, well, he would not have been able to sell these because he wouldn't have been registered properly. So the insurance industry spent
a lot.
Nine figures to lobby to keep these in the control, the sole purview of state insurance regulators who have proven to be among the wimpiest regulators in the entire world. There.
I think everything you just said is fair. So
so let me just do, again, moral of the story. Be very skeptical of anyone you listen to on the radio, at church, in a social club, a relative. Be really skeptical of anything anybody tells you about money. And then if they promise you anything that even halfway sounds like it might be too good to be true, like a higher than the stock market return with no downside risk, anytime anybody says that to you, it's a lie. Oh, wait, let's do it this way. It's a lie.
That sounds very angry. I think it's just be skeptical in general. This is your money.
Yeah.
And you should be this. It's not important, not as important to anybody else except you, right? I mean, this is your money. So be skeptical. Good advice.
Yeah. And the other thing you need to bear in mind is that almost everybody who's on the radio these days, particularly local radio, and that includes us, has to pay to be here.
That's right.
We're not like the good old days when I got $100,000 a year for talking on the radio.
Yeah, I know.
That was it. That was actually what I got. That was my high point pay at Business Radio Network. Was at 90 stations and $100,000 a year was my big. You look back at your Social Security record, you can find those cool things.
Okay, so different world today, no question. So pay attention.
Pay to play. But at least there truly are a few companies. I can count the podcasts of which I'm aware on one hand that I know are always required to act as fiduciaries. It's not very many, which means the rest are problematic, problem children. 855-935-TALK is the phone number we use every Saturday. We do this on Saturdays so that you can call us to get answers to your questions about, seriously, if you ever thought about calling a talk show about anything else pales by comparison in the grand scheme of hierarchies of need.
I thought you could call us for anything. I don't want to give personal advice on your personal relationships, that kind of thing.
Anything money oriented. We have that very important word in the title. talking real, not stuff, money, just money, not stuff.
That's good. Yeah.
I was giving you a chance to talk now, but you didn't want to.
Talking
apparently.
real stuff. That's my cue. Well,
Yeah.
I have questions. I have all bunch of
No,
stuff
you can't do that. Yeah, we're just going into a break. I just wanted you to.
Okay.
I just wanted you to have an option to.
Thank you for
to
that.
interject, but
I honor.
But
that,
apparently the vacation is already on his mind.
I'm trying to take a break from him to do
He's
the show.
sitting around planning for his trip to Normandy again. This will be the 14th annual visit to
Tom
Normandy.
and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
855-935-8255 is our telephone number, and we are talking money with you. 855-935-TALK. See, talk is in that too. And by the way, if you want to hear me on another podcast, recently I did a podcast with a young man by the name of Jesse Kramer, who's a fiduciary advisor out of New York, and he does a podcast called Personal Finance for Long-Term Investors. It's a little wordy, but it's on all the major podcast services. And if you want even more of the downside of equity indexed annuities, you'll get it there.
Yeah, and back to the just closing, and you caught me by surprise, but I would say
I try to do that, and I'm occasionally successful.
Teacher that could give you a very expensive lesson. Let's just put it that way.
Oh my gosh.
Expensive. So
I mean, really, this is what's so bad about this stuff. You think, okay, I'm going to give somebody $1 million and they're promising me an 8.5% return.
Right.
Well, that means in 10 years, I'm going to have over $2 million. Nowhere in this contract, nowhere do you ever get anywhere near $2 million. It's not possible.
Nope.
It's just not possible in a 10 or 12 or whatever year period. And the likelihood of it happening ever even if you never took income from it, pretty slim. Anyway, you got questions for us?
I do. Maz
has
writes
all the
us
paper questions.
From Irvine, California. I'm a regular listener. Thank you for your invaluable advice over the years. That has at least saved me from crypto, despite the onslaught from coworkers and family. Individual stocks. Arguing with my dad, he wanted me to buy Tesla, and yes, Argentinian bonds. No, not really. I don't know about them.
Did you add that part?
I did not add that.
She put it in. Oh,
no, but
okay.
this is we touched on this one yesterday. So this is fascinating because the question is, why is there a return difference on Morningstar when the exchange traded fund is compared with mutual fund? So he sent us a comparison between VTSAX, for example, and
is this
VTI,
we talked about this one.
And we went back. Well, okay, we went back in and the VTWAX, and VT. VTWAX is the global mutual fund, global equity mutual fund with at Vanguard, and VT,
it's the mutual fund version.
Yeah, and VT is the exchange traded fund version of that, right? Okay, so
correct.
We thought when we saw this, we were kind of freaked out. I'll be honest with you, because I thought, wait, all this time we've been telling you just own the exchange traded fund. It's the same thing. And he said, no, the returns have been different. So we decided to go back and look. Yeah. And
there's a difference. They're not the same fund.
5 years for one thing. No, they're not. But we can only go back 5 years, and the 5-year return is exactly the same. No different.
Apples to apples to apples
correct.
to apples, because the Vanguard, I think what he was doing was comparing VTI. Was that what we thought?
He had another one in there, VTI and VTSAX. That's the international.
Yeah, well,
version,
VTI is not the same as VTSAX.
Well,
VTSAX was the old VTWAX.
That's correct. So we, as far back as we could go, was 5 years with VT and VTWAX, and the return is exactly the same. No difference. So then we started thinking, oh, wait, maybe there is some difference. So we looked at BND versus, which is the Vanguard Total Bond, right? The ETF, Total Bond Market, versus VBTLX, which is the Total Bond Mutual Fund. And there's a lot of letters. I get it. But we went back and looked at the 10-year, annualized 1.44 for each one of them. Year to date, 1.52 for each one of them. So it was all the same.
It's all the same.
Maz, you could write us back, but I cannot find a difference between them. And frankly, there should not be.
No, the only difference should be that is encompassed in the higher expense ratio of the fund. because the
Correct.
funds have a slightly higher expense ratio
They do.
than the, I think on BND it's 0.04 to 0.03. And I think on
VT wax versus VT.
I think the difference is a little bit greater. I think what? Morningstar servers just stopped responding.
Well,
I think the difference was about 5/100ths of 1%, somewhere in the ballpark, but I don't remember.
So, but they're close. So there could be a little difference there. But the bottom line is, Maz, we can't find any reason to use one over the other than the tax benefit of the exchange traded fund. They are the same thing. So there you go.
Oh, wait, I just remembered. We're recording this on a holiday. We're doing this live on a holiday weekend, aren't we?
Yes, this holiday. Yes, this is Memorial Day. Well done.
Yeah, call us 855-925-TALK.
Tom and Don are talking real money. Reality radio for a really great future. We're talking real money.
Yeah, we are. We're here to help you with your money stuff, and you can call us at 855-935-TALK, 855-935-8255. And one of the things we talk about on Talking Real Money all the time is just good old-fashioned logical investing. And I am so happy that finally the U.S. government has figured out that losing money making money is not a sustainable investing strategy.
We've seen it done, and it doesn't look good.
It doesn't
long-term.
work.
No, it's not good.
Yeah,
No.
so apparently when you spend 4 cents to make a cent,
time's up.
you're not going to make any money.
Yeah. Yeah, I mean, this is kind of sad in some ways because it's been part of my life for 60 plus years.
Not
right?
a big part.
Not a big. Well, actually, the big part's fat. We're talking about getting rid of the penny. The penny is going the way
the penny is
of the dodo bird, the moderate politician, and the successful stock picker. They're not going to start. They're not going to make any more of them starting early next year. So that's that. And here's the other part that's going to be somewhat tricky. How are you on counting by fives? 5, 10, 15. I mean, it's going to get a little harder there. Doing all that stuff.
Wait. You know what? I have something right here. iPhone.
Oh, you can just
got a
like
calculator.
everything else. Yeah, everything. But yeah, so the penny.
I have artificial intelligence to do the math for me.
Still going to use them for a period of time. But here's the part that I found fascinating. According to this article in the Wall Street Journal, they claim that $14 billion, that's with a B, is sitting around in coin jars. It makes me want to break into more. I could get John Hamm in here to break into some more homes or something. I mean,
I gotta go.
$14 billion?
I got to go check my giant piggy bank. I probably should count what's in there.
I don't have any because I haven't used cash in so long that I literally don't have any.
Well, no, this is left over from decades and decades.
So you actually have a jar of pennies.
No, I have a giant piggy bank, a really big one, about like that big.
That's crazy.
Probably has 5 or 6 pounds of change in it.
All right. Well, then
now I got to tell you though, there is $14 billion
problem.
There is one. Just one area where the news is bad. I read that couch cushions everywhere are crushed, much like government employees, because they're losing their only source of income.
Their only use.
The change. They're not getting it anymore.
I know.
I'm sorry.
That's good. Yeah. So pennies going away. I mean, how many people are using, coins anyway, today's world? It's less and less, right? Or dollars or 20s
and I see fewer and fewer fountains to throw them in. Just not a lot of options left.
And speaking of throwing them, according to this article, Americans, it says throw away up to $68 million in coins every year.
Yeah.
They must be wealthy or something.
I got to tell you, I truly hate change. I hate change. My wife is always saying, well, we've got some cash. You spend it. I don't like spending cash. Why don't you like spending cash? Because they give me change.
And then what are you going to do with that?
Then what do I do with it?
That's fair. That's fair.
It ends up in my pocket. Yeah. Then it ends up on the
hole in your pocket.
On
dresser.
I can't even remember the name of that wooden device in my bedroom. It's called a dresser. It ends up on the dresser.
So the penny, it says, was one of the first coins made by the mint after its establishment in 1792.
That's back when a penny was worth a penny.
Right, exactly. Yeah.
It actually went somewhere. Just.
So can I give you my 2 cents worth on this one? Is that okay?
Yeah.
This is a really good idea plan. Yeah. It really is. So
It is I'm
literally going to be
it.
pennies from heaven here on this one. So,
and and the other thing that I think about is the fact that it is, in fact, the only coin that costs more than it's worth.
No, I think they said nickels is almost in the same place or something.
Oh, see, it was reminding me of your first marriage. I was going to let you do the first marriage joke.
Usually you don't have to wait. I'm usually right there with it.
You're usually there with it, and you didn't use it. So I thought, Tom's going to use the first marriage joke. I know he is.
That's one out of four that's funny, so we'll take it, but not today.
Well, I think we had 4 jokes and I'm not sure any of them were really funny.
That's a good point.
They were amusing,
marginally funny.
They were amusing. 855-935-TALK. That is a phone number that is totally and utterly available for you to use right now
at this moment.
Yeah. So ready?
Wow. No, don't.
What? Please call us. 855-935-TALK.
Tom and Don are talking real money.
Hi, Don McDonald here. So, what's your plan for retirement? No, really. What's the actual plan? Because hoping the market goes up, stockpiling random investments, and praying your gut instincts are smarter than Wall Street is not a plan. It's a guess. And when the market gets bumpy, and it always does, guessing leads to second guessing. And second guessing leads to panicking. That's why you need more than a portfolio. You need a purpose, a strategy, a real financial plan built just for you by a 100% fiduciary advisor who's legally obligated to act in your best interest. Imagine that. Start your plan today with a free, no-pressure meeting at TalkingRealMoney.com or call 800-386-3004. That's TalkingRealMoney.com, because your future deserves more than crossed fingers and wishful thinking. By the way, no sales pitch, no obligation, just smart help for real people who want to stop guessing and start planning. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more details.
Your guides to a really great financial future. Tom and Don are talking real money.
And our phone number is 855-935-TALK, 855-935-8255. Call us now or later, because we like taking your questions. We even have a question that came in from our 51st state. Which actually,
we're not supposed to say that anymore.
I'm
That's
joking.
Derogatory.
Actually, I think it would be states 51 through 60, and then 3 more territories. So it wouldn't be just. Would you? I mean, you wouldn't let Canada just be one big state. It would be the big one, like bigger than Alaska.
Yeah, it'd be huge. That's
huge,
what I think. Isn't it 13 provinces?
It's 10 provinces and 3 territories.
Oh, okay. Shows you what I know. So, okay.
Yeah.
Anyway, yes, this comes from one of our regulars up north. Yeah, it's nice of him, Jeff.
Not Nunavut north, but like below that.
Yeah, exactly. So he writes and says, I was going to call in today, but there's a long topic, so I thought I'd write you instead. If you guys find the time, says. So he apparently knows a lot about our program today. Could you talk about...
Because it's a holiday.
Yeah. Could you talk about bond yields and bond prices, particularly the inverse relationship? Is this similar to the inverse relationship between stock prices and stock dividends? Bond yields and bond prices. And there's been a lot of discussion about them.
No, it's not like the stocks and stock dividends. That's not the same kind of relationship, even close. Because, and by the way, I just want to reiterate that we usually take the show much more seriously than we are this weekend.
Oh, do
because none of... Well, a little more seriously than we are this weekend, apparently, because this is a holiday that I forgot about.
This is the holiday version. Got it.
Back to my basic premise of grumpy, curmudgeonly life.
Yes.
Holidays stink.
Okay. Bond yields it's and like bond prices.
It's kind of like what we're doing today. It's like child's play.
Yep.
It's like a teeter-totter, a seesaw. Okay?
That's exactly right.
When rates rise, bond prices go down. They're on the other side of the teeter-totter. When yields fall, the value goes up. And here's why. Here's why.
Pretty easy to explain, actually.
Let me do the why. The why is really easy. Let's start with a $1,000 bond. And let's say it's a magic bond, like the equity indexed annuities, that pays 10% a year. So you get $100 in interest.
Yep.
Okay? On your bond. Wow, that's great. Sure. Now, interest rates go up. They go up to 12%. Your bond is still worth $1,000. Wait, you can get a new bond that pays $120.
So you get the point here. No one's going to want to own your old bond anymore. Well,
so what they're going to do, they're going to look at your old bond. They're going to go, okay, that's a 10-year bond.
Yep.
So I need to figure out a way to make the equivalent of $120 a year on that 10-year bond. So I am going to pay you $20 a year times 10 less, or $200 less. Yeah. Your bond is now $800. That's what it's really worth. Mm-hmm. Works exactly the same in the opposite direction, just like the seesaw.
Now, if you bought the 10-year bond and it's paying you 10% and you hold it the whole way, you get the 10%.
You get the money back.
And then you get the money back.
Right.
Yeah. So
you have to hold it to maturity.
Correct.
Otherwise, in the secondary, and here's the part that I think makes it difficult for everybody to understand. It is only in the secondary market that the value fluctuates.
That's what I was trying to say. Right.
And that's why we think of it differently than we do bank CDs, although in the secondary market, they behave just exactly the same.
Yep.
When you buy a CD at a bank, you're saying, okay, I know, I'm not going to take my money out for a year. If I do, I'm going to suffer a penalty. Well, now if you bought a CD in the secondary market, the exact same situation applies. If you want to get out in less than, you got a 10-year CD, you want to get out less than 10 years, you're going to have to discount that if rates have gone up.
Yeah. So, okay, so to go back to where we are today, because we're in a bit of an unusual situation today.
Well, that's right? Because nobody can possibly figure out what's going on.
That's the point, because things have been kind of seesawing. But we're now at the place where the 30-year U.S. Treasury is yielding about 5, I believe, correct?
I believe the yield curve has gone back to something resembling normal.
Exactly.
Yes.
Where before we had this inverse yield. So,
right.
So we're back there. But things have been fluctuating a lot in recent weeks, and that's caused people a lot of concern. Like, what is going? This thing that we thought was kind of stable that we didn't have to worry about is moving around more than people are comfortable with. Let's put it that way.
Right. Which is why you need to start thinking of your fixed income portfolio in fixed fashion, not as a resellable asset. And I honestly think this increases the need. The importance. I think there was a time when you could own a bond fund and it didn't move a lot and you were still good. I think we're coming into an era where having laddered fixed income portfolios for your sanity is becoming a bigger deal.
So rather than owning a bond fund, is that what you're saying?
I really feel much more strongly about it's merely psychological. Yeah. It's the psychological feeling of certainty you get when you know you've got one of your CDs or bonds coming due within the year. I don't have to sell it. I can just wait for it to mature. Even though the market is pricing it lower, if I wait, I just get my money back.
Yeah, if you come and see me, I'm still going to recommend exchange-traded funds of a widely diversified portfolio of bonds.
But you need to go in with an understanding that I don't think was as necessary over the last 50 years.
Maybe so. But again, the question would be,
again,
what would
it's
you
psychology.
do different? What you're saying is you would ladder them yourself. You've said that for a long time. Most people,
it's harder work.
It's a lot more work. Yeah. I'd rather rely on Vanguard to do it. So
right. And they're doing the same thing.
Yep.
See, I am merely talking about from a human brain perspective. We are wacky. We are illogical. And we are highly emotional. And when we see our bond fund, what did BND go down in 22?
Boy, I think 13%, 14%, something like that.
For a lot of people, that's a stock market type.
Yeah, well, that was a fairly unique year in bond history, if you will.
But yeah, it was 13 point. Actually, between 21 and 22, it was 15%.
So I was close. So
yeah, it's a lot between those 2 years. Anyway, that's how it works. I hope that was understandable. It didn't take us too long, did it?
No, but it's a very important issue for people to understand, because if you're going to own bonds, you need to know how they work, and that's at the crux of them. So the thing I think you need to remember is, again, with bonds, you want to keep them short and intermediate term. You want to be diversified, and you want to have low cost for most people.
Right. And if you are going to build a ladder, remember, it has to be disciplined. You can never try to second guess your ladder.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
Turns out you got to answer the phone, do you?
No, we answered the phone.
Oh, okay.
We just got some calls.
Okay.
Okay, quick. Let's go to Colorado. James, welcome to Talking Real Money.
Hi, I know I only have a short little time slice here, but I'm a retirement researcher, portfolio researcher, and I write papers and stuff on retirement portfolio research.
Wow.
And I'm taking a survey of financial planners, and I know that Gallarducci says that in her book, she says 50% of retirement age investors haven't saved enough for a decent quality of income in their retirement. And I would ask you if you would agree with that with your clients.
No, because our clients are self-selecting bunch. So basically people that come and see us have to save something, and thank you for your hard work on this important topic. So we're not very, we're not a very good, bellwether, because the people we talk to generally have saved something.
Yeah, because by the time they get to us, they have built a portfolio through their work, their own IRAs, they're savers and investors to begin with. They just get to the point in their life where they really need a lot of specific guidance, tax guidance, income guidance, that kind of thing.
Yeah, because I'm trying to develop a portfolio that will go above the 4% rule, and it'd be paying 5.5% annually, inflation adjusted. And it involves small cap value ETFs, large cap value ETFs, total bond market ETF. And I thought that a 38% higher annual income rate would be very helpful for somebody who hasn't saved enough if they had this type of portfolio offered to them.
Well, and that's one of the reasons why we're huge advocates of a flexible withdrawal strategy as opposed to the 4% rules, or 4% rule, because that extra income can make a huge difference. And it only means that in the fewer bad years that you have to adjust lifestyle. And if you are capable of doing that, or you put away at a lifestyle adjustment fund that's in an emergency thing, then you can really do a slightly higher withdrawal ratio. And yeah, I'm a big fan of building portfolios that do just that.
Yeah, we thank you for your, again, we'd love to hear more about this in the future, so feel free to call us again.
Okay.
Sounds great. Thanks, James. We appreciate it. 855-935-TALK is our phone number. That's 855-935-8255. Give us a call, because this is one of the few places where you can discuss money and get an honest, straightforward answer from somebody who is not trying to sell you commissioned products. Now, of course, we do manage people's money, but...
But we do actually educate. Can I mention one of those educational things coming up if you're a federal employee? Because it's been a very unsettling time, obviously, with layoffs. You've read all the stuff. So we're going to be doing a couple actual classes on how you can make sure you're going to be okay coming up on June 5th and June 7th. You simply go to AppellaWealth.com, click on events. And this is for federal executives who are stressed out, frustrated, worried. We're talking about the program, how to get yourself set up so that no matter what comes along, you're okay. So again, those are on June 5th and June 7th. These are online, obviously. And
how do they sign up?
They're free, and they go to AppellaWealth.com, click on events.
APELLA wealth.com. Click on events. And if you want to send us questions or you want to, whatever it is you want to do, you want to talk with one of our advisors, just go to talkingrealmoney.com. That's
talkingrealmoney.com.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit talkingrealmoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.